In India, RBI's Central Board of Directors takes the decisions regarding the interest rates. The benchmark repurchase rate is the official interest rate. In 2014, the main goals of the RBI's monetary policy were stable prices, less importance to government's borrowings, stable exchange rate, and promotion of exports. In February 2015, RBI and the central government decided to bring consumer inflation up to 4% with a ceiling of plus or minus 2% from the financial year ending in March 2017. After studying this module, you shall be able to know about the various terms related to the structure of interest rates, know about how RBI's policies can influence the structure of interest rates, know about the rate of interest prevalent in India in the last 3 decades. Let us first discuss the various aspects related to the interest rate structure. Repo rate. Whenever the bank require more funds, they can ask RBI to lend it to them. The rate at which RBI will lend funds to the commercial banks is called the repo rate. A lower repo rate signifies that now the banks can borrow funds from the RBI at a lower rate of interest, whereas a higher repo rate conveys that the funds can be borrowed from the central bank at a higher rate of interest. A repo or repurchase agreement is a money market instrument. Usually, the central bank's Federal Bank in US and commercial banks are involved in a repo transaction, but these transactions are not limited only to these two entities. Individuals, banks, financial institutions can also participate in repurchase agreements. Repo is a collateralized transaction, that is, the banks that want to borrow money, the RBI need to sell securities, usually bonds, to Reserve Bank with an agreement to repurchase the sum at a predetermined rate and date. Thus, for the lender, usually RBI, the securities sold by the borrower act as a collateral against the risk of default, and for the borrower of cash, usually commercial banks, cash received from the lender is the collateral. Reserve Bank charges some interest rate on the cash borrowed by banks. This rate is usually lower than the interest rate on bonds as the borrowing is collateral. This interest rate is called repo rate. In a reverse repo transaction, RBI borrows money from the commercial banks by lending securities. The interest to be paid by the Reserve Bank in this case is called the reverse repo rate. When the terms of the loan is for 1 day, it is known as an overnight repo, and if it is for more than 1 day, it is called a term repo. Next is bank rate. Bank rate is that rate at which the central banks lend funds to national banks. A central bank controls the supply of currency within national boundaries by changing the bank rate. If there is a need to increase the money supply, the central bank reduces the bank rate, thereby increasing the desire of commercial banks to borrow and vice versa. A bank rate is that interest rate which a central or federal bank charges on the loans and advances to adjust the total money supply in the economy. This is usually done on a quarter-to-quarter basis to control price rise, that is inflation, and to make the country's exchange rates more stable. A change in bank rate invokes a manifold effect as it affects each and every aspect of the economy. For example, the stock prices react to interest rate changes. A change in bank rate impacts customers as it impacts prime interest rates for personal loans. Next is types of bank rates. The bank rates offered on different types of monetary instruments are described hereunder. Savings account bank rate. Modest rates are charged on funds deposited in the savings accounts. However, investors have high flexibility in withdrawing the deposits. Certificates of deposit CD bank rate. These offer comparatively high interest rates compared to savings account. Bank rate on commercial deposits are influenced by the term period of a deposit and the current economic scenario. The longer the term period of a commercial deposit, higher is the interest rate. Money market funds bank rate. The interest rate on money market funds is relatively low. As most of the money market accounts are privately insured, it is a secure method of investment. Deposits in a money market account generate interest through short-term investments. Next is cash reserve ratio. In order to meet contingencies, the law requires the commercial banks to hold some portion of their total deposits as liquid asset, that is cash. However, in reality, banks do not hold cash with themselves, rather with the RBI, which is as good as holding cash. The portion of funds required to be held in this way is decided by the RBI and is known as the cash reserve ratio, that is CRR. Higher the CRR, lower the amount of funds that the commercial banks can lend. For instance, if the bank's deposit are rupees 400 and the CRR is 4%, bank will be required to hold rupees 4 with the RBI. Now, if the CRR becomes 5%, the banks will now be required to keep rupees 5 with the RBI. Earlier, the banks could lend rupees 96, but now they will be able to lend only rupees 95. In this fashion, the CRR works out to be important instrument in the hands of the RBI to control the amount of funds that the commercial banks can lend. The RBI's medium-term policy is to bring the CRR down to 3%. In the past few months, the money that is available with banks for giving out as credit is greater than the amount they have been lending out. This has led to an overhang of liquidity in the system. The objective of the CRR hike is to mop up some of the excess liquidity in the system. The hike in CRR is not likely to lead to an immediate increase in interest rates. There is excess liquidity in the system even after a higher amount is deposited with RBI as reserves. Unless the demand for credit increases to an extent that all money has been lent out, banks will not be inclined to raise interest rates. If the economy is experiencing a growing trend and a high inflation, it signifies that the interest rates are going to increase after some point of time. If the inflation keeps rising, the RBI might increase the repo rate, the short-term rate at which commercial banks park funds with the RBI. This leads to less inducement of banks to lend at the prevailing interest rates. Besides, the RBI might raise the bank rate, the rate at which commercial banks borrow from the RBI. In this situation, the interest rates on home loans and FDs are also expected to go up. Over a year, rates could go up by as much as 3%. Next is role of interest rates. Interest rate has diverse roles in the economy, such as a reward to capital, which is a factor of production in return to saving, and a cost to investment and an instrument of monetary policy for credit control. The role of interest rate mechanism in India has been the subject of controversy. In fact, there has been a controversy about the role of interest rates in an economy from the days of Lord Keynes. Thus, it is relevant to examine the role of interest rates in India. Do interest rates affect mobilization of savings? To what extent interest rates affect the amount of funds deposited with the banks and shifts between deposits of various maturities? These kinds of aspects are quite pertinent for the policymakers. At the macro level, interest is the reward to the capital, which is a factor of production. In the developing economy, capital formation and capital accumulation are of vital importance to economic development. Interest rates affect both savings and investment in the economy and serve a vital role for the mobilization of savings. Thus, in addition to influencing their cost and availability of funds from the supply side, interest rates also influence the quantum of investment from the demand side and thus determine the income and employment within the economy. Interest rates bear a pertinent role in the investment process in India. Some empirical tests have shown that the domestic capital formation in India is a function of GDP, MEC and the cost of capital. Next is factors influencing interest rates. Savings flow into various physical and financial assets. Financial assets are future claims on money like bank deposits, UTI units, shares, debentures, etc. These are in the form of IOUs. These financial assets have a structure of interest rates which should be rationally based on the degree of risk of ownership, uncertainty of return, period of maturity, and a host of other factors. The factors which influence interest rates on various financial investments are the nature of the instrument, maturity period, risk, tax status, marketability, and liquidity. These are as discussed first. The return on ownership capital should be higher than on loan capital as the risk of the former is greater than that of the latter. Second, difference in maturity period will affect the extent of risk taken during the period when the lender is out of funds for varying periods of time. Ordinarily, the longer the period, the higher is the interest rate. Third, the degree of default risk or uncertainty of returns would also determine the interest rates. Such risks are negligible in the case of government bonds, while they are higher in the case of private debt or private ownership securities or company deposits. The rate is to be higher on those which have the higher risk. Fourth, the tax provision on the financial instruments or incentives or disincentives in the form of taxes on interest income or tax concession would also influence the demand for different type of financial assets. Thus, the effective rates on some postal certificates are higher due to tax concessions, which will increase the effective take-home rates. Fifth, another factor is the marketability of the financial instruments with facilities for discounting or rediscounting and or ready salability, which thus imparts liquidity, and or ready salability, which in turn give liquidity to instruments. Liquidity means convertibility of assets into cash as and when required without loss of time or money. Sixth, safety of funds is another factor and is reflected in the credit worthiness of the borrower and expected return flow of principal and interest money. There are some limitations of the system which is controlled by the government, RBI, and to some extent by the market forces. The multiplicity of controls and the agencies controlling have made the interest rate system in India complicated and distorted. This complex system prevailing even in the organized markets is made more difficult to comprehend by the generally uncontrollable interest rates charged in the unorganized and primitive markets in India. Structure of interest rates. Leaving aside the time factor, the increase in risk in respect of banks' lending rates and then longer period involved in such lending have been reflected in the higher level of interest rates on them. Contrary to the call money rates or T-bill rates, which are for short periods, the interest rates on debenture, PSU bonds and term lending rates by banks are higher due to higher risk involved. Thus, maturity period, safety and certainty of funds, etc. would impact the relative levels of interest rates and the structure of rates. There are many types of instruments with varying rates of interest in India. These rates will get influenced by the features of these instruments such as ownership risk, variability of return, maturity period, safety, marketability, etc. The data clearly brings out the upward and downward shifts in the structure of rates depending upon the level of risk, time period of maturity and other features of the financial instruments involved. In India, some of these interest rates are fixed by the government. The bank deposits and lending rates and those of financial institutions are fixed by the RBI, while the rates on PO instruments, PSU bonds and those on government securities are all fixed by the government in consultation with the RBI. The rationale for monitoring interest rates in India is as follows. First, it keeps the interest cost low for the government borrowings and their investments. Second, it promotes the socio-economic objectives of providing cheaper finance to weaker sections and priority sectors of the economy. Now we discuss the influence of RBI's policies on the structure of interest rates. Each of the various maturities of financial assets in the money and capital markets of the country has its own interest rate. The varying interest rates in India in the organized financial system are determined by two factors: the RBI's policy and the interaction between the demand for and supply of investable funds. Basically, the interest rate structure of the organized financial sector is determined and governed by the RBI. The Reserve Bank's policy operations can affect the structure of interest rates in the following manner. First, by charging the treasury bill rate. Second, by changing the bank rate. Third, by fixing the minimum and maximum lending rates of banks. Fourth, by fixing the maximum interest on time deposits with the bank. Fifth, by affecting call money rates through changes in the reserve requirement ratios. Sixth, by influencing yields on government securities through open market operation sales and purchase activities. Indeed, the relative mobilization and channelization of saving and investment are greatly affected by interest rates. Interest rates can positively affect the growth rate in an economy in the following ways. First, by discouraging the flow of credit in unproductive and uneconomical uses. Second, by curtailing non-essential consumption expenditure on luxurious items. Third, by mobilizing savings into banks in the form of deposits and thereby enhancing the bank's capacity to extend more credit to satisfy the need of the growing economy. Fourth, by motivating the flow of funds into government treasury through public borrowings and making it possible to have increased public spending for development purposes. For 2016-17, more economic growth is expected due to a normal monsoon after 2 successive years of rain deficit. The gains from terms of trade, enhanced real income of households and reduced input costs of the industries. However, lower private investment demand, concerns regarding the stalled projects, excess capacity in the industry and less export growth due to sluggish overseas demand could act as deterrents. The current momentum of growth is reasonable, though below what should be expected over the medium term. Underlying growth drivers need to be rekindled to place the economy durably on a higher growth trajectory. A spurt in private investment will bear a crucial role as the climate for business is improving and fiscal policy continues to consolidate. Throughout the world, the Indian economy is being viewed as a biocon of stability due to the steady disinflation, a modest CAD, and commitment to fiscal rectitude. There is a need to maintain that so that the roots of stable and sustainable growth are strengthened. Structural reforms introduced in the union budget will boost growth, while controlling spending will create more space for monetary policy to support growth, while also ensuring that inflation remains on the projected path of 5% by the end of 2016-17. Now, let us summarize what we have learned in this module. The rate at which RBI will lend funds to the commercial banks is called the repo rate. Bank rate is that rate at which the central banks lend funds to national banks. There are 3 types of bank rate, which are savings account bank rate, certificates of deposit CD bank rate, money market funds bank rate. The portion of funds required to be held in this way is decided by the RBI and is known as the cash reserve ratio CRR. The factors which influence interest rates on various financial investments are the nature of the investment, maturity period, risk, tax status, marketability, and liquidity. The varying interest rates in India in the organized financial system are determined by 2 forces: the RBI's policy and the interaction between the demand for and supply of investable funds.